This is where it starts to get really interesting, because the subject we're about to cover, in my experience, is one of the dominant techniques that helps to build trading rules that will have the most significant impact on the performance of trading systems. But in previous episodes we've already looked at many uses of indicators, and in particular oscillators. So what is it that will now give us these compelling improvements? Well, today we're going to start looking at trend filters. And if used correctly and in line with what I'm going to share with you in the next 3 episodes, your system will be able to be much more selective about which trades it takes and which it doesn't. Stay tuned. It was discovering how to properly utilize trend filters that was probably one of the biggest shift changes in my own journey to becoming an algo trader. But as I said in the introduction, we've already covered quite a lot of ground in terms of using indicators and using oscillators in particular. So we've looked at how to use them as triggers, and we've also looked at them in terms of volatility filters. But it's the introduction of these trend filters that is going to enable you to see some really great improvements in the performance of your system. So let's now take a look. So first off, why is it that using a trend filter is so beneficial? And the most simplistic explanation of this is that, well, some trading systems tend to work better when the market is in a trending mode, whilst others work better when it's not trending, so when it's in a trading range, for example, and this is typical of mean reversion systems. And so depending on the type of system you've developed, whether that's a trend following system or a mean reversion system or a breakout system, by filtering out those trades when the conditions aren't right for that system, can have this significant improvement in the performance. Now, from what I've already said, you've probably guessed that the benefits, in my opinion, of a trend filter actually outweigh those of a volatility filter. But of course, in reality, you don't have to choose one or the other. You can use both of them in conjunction with each other to get that optimal performance from your system. Now, from my experience, there are 3 main types of oscillator-based trend filters. And I've given these types the names single line non-directional, single line directional, and dual line. There are, of course, other types of trend filter, but these tend to be trend following indicators. So although I won't be covering them right now, I will be covering these in a future episode. Now, just like I did for the use of oscillators as triggers and volatility filters, I used this idealized sine wave to explain the concepts, and I'll do that again now for trend filters. However, again, just like last time, I'll then move on to real charts once you've got that understanding. So let's now take a look at the first type, which is the single line non-directional. So the way that these tend to work is that if the indicator line is in the upper region, this is an indication that the underlying asset is in a trending mode. And then when the line is in the lower region, this is an indication that the asset isn't trending. So there's an obvious disadvantage to this type of indicator, that it doesn't tell you which way the trend is. So regardless of whether it's an uptrend or a downtrend, the line will still be in this upper region. So when you use this type of indicator, you must use some other mechanism to determine the direction of that trend. And an example of this is the main line of the ADX indicator. Now, as you'll know, ADX is not one of my favourite indicators, but it is probably the most obvious one that fits into this category. And in the case of ADX, it does of course have 2 more lines, which enable you to determine that direction. But there are other indicators out there that also fit into this category that don't have the benefit of giving you that additional information about the direction. And so for those, you really would have to look to somewhere else in order to find that information. But that disadvantage of this type of trend filter isn't something that we see in the second type, which is the single line directional. This type of trend filter does give you the information you need about, firstly, whether we are trending, but secondly, in which direction. So again, typically the way this kind of indicator works is that if the line is in the upper region, this is an indication of an uptrend. If the line this time is in the lower region, this is now an indication of a downtrend. And so what happens if we're in this middle region? Well, this is an indication that the market isn't trending. So for example, it might be in a trading range, or it might simply be a change of direction. So going from an uptrend immediately to a downtrend or vice versa. And what's a good example of this? Well, you might be surprised to find that stochastic is actually a really good indicator to tell us this kind of information. And you'll have gathered this from some of my previous episodes where I talked about the stochastic line staying in these extreme regions, either above the value of say 70 or below the value of 30. And when that line does stay there, that's a really great indication that the market is in a trending mode. So stochastic itself does prove to be an extremely flexible indicator because you can use it for things like this, for telling you the trend, in addition to using it as your trigger. But when you used it for that, it would of course be on a different time frame to your filter. And you'd also use the information from it in a different way. So you'd be looking for these extended periods of time when the indicator was in a particular region, as opposed to using it for trigger points when the stochastic line crosses certain levels. And so now let's take a look at the third type, which is the dual line. And for indicators that fit into this category, they usually have lines called, for example, the up line and the down line. And the way you'd use this type of indicator is that when the up line is in the upper region, this is an indication that the underlying asset is trending upwards. But when the down line is in that upper region, this is an indication that the market's trending downwards. And a good example of this type is the Aroon indicator. Now this type tends to be incredibly flexible. And if you remember in the previous episode where I asked you to take up a challenge and to test yourself in terms of how you understand the indicators you're using, this indicator is a really great one to do that challenge with. So for example, based on the number of periods you're using for this, it's very easy to look at different levels at which you should be classifying the market in this way. So as an example, in the illustration on the screen now, we've considered that if the upline is above the midpoint, then it's trending upwards. But in order to classify stronger trends, you can take this approach where you set the level higher, so in this case at about 70, and so each line has to be in that region above the 70 level to properly classify the market as either trending upwards or trending downwards. And this will help to filter out those weaker trends. And so now we have this middle region where neither of the lines are above our specified level. And this of course gives us the information that the market isn't trending or indeed is changing direction. Now, just like with volatility filters, you need to match the time frame of your trigger and your filter in order for this to work properly. And as we said for volatility filters, usually filters operate on a different time frame, and that's usually a higher time frame for the filter compared with that of the trigger. So for example, if your trigger is on the 15-minute chart, then your trend filter might be on the 1-hour chart. Or alternatively, if your trigger's on the H1, then your trend filter might be on the H4. But as you can see, the multiple between the two is still the same, a factor of 4. Now in the next episode, I'm going to start looking at real charts to assess the trend, and I'm going to use this type 3 dual line oscillator. And in particular, we're going to look at a lot of detail around the Aroon indicator. And the reason I like this so much is that, firstly, the premise behind the calculation is really simple. And as you've heard me say 1,000 times before, simple is usually best. The second reason why I like it is that it's a range-bound indicator, so it ranges between 0 and 100. And this, of course, makes it suitable for using across different asset classes in a systematic way. So that was just a basic introduction really into trend filters and how they can be used. But if the next episode where I'm talking about the Aroon indicator is already released, then you'll find it at the top of the screen right here. If not, then please do subscribe to the channel so that you get notified when that episode does get released. So thanks for your time today, and until next time, trade safe.